Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Now that you know about small cap stocks and IWM, let's dive into some strategies that can help you make the most of these high growth opportunities. Let's get started. Benefits of investing in small cap stocks. Small cap stocks offer unique opportunities for investors looking to diversify their portfolios and take advantage of promising growth. While they come with higher risks, the potential rewards often make them a worthwhile consideration. Below, we'll dive into why small cap stocks might deserve a spot in your investment strategy. High growth potential. Small cap stocks are often seen as hidden gems with room to grow. These companies, being in the early stages of their business cycles, can rapidly expand their market share, improve products, and explore new territories. Unlike their large cap counterparts, which usually post stable but modest returns, small cap businesses are more likely to deliver significant growth over a shorter period. Here's an analogy. Think of large caps as the oak trees of the market. They're sturdy and predictable, but don't grow much bigger. In contrast, small caps are like saplings, younger, less predictable, but with the potential to grow much faster if given the right conditions. For investors with long-term horizons, this growth potential can translate to impressive returns, especially during economic recovery phases when smaller companies tend to outperform. Though not every small cap stock will be a big winner, the category as a whole represents businesses that could evolve into tomorrow's market leaders. If you're ready to take on a bit more risk, this is one of the best ways to pursue higher than average growth. Market inefficiencies and opportunities. Small cap stocks tend to receive far less attention from analysts and institutional investors compared to large cap stocks. Why does this matter? Because with fewer eyes on these stocks, the likelihood of uncovering undervalued opportunities increases. Limited analyst coverage often leaves smaller stocks under-researched. This creates a less efficient market, meaning prices don't always reflect a company's true value. For individual investors willing to put in the work, reading earnings reports, understanding industry trends, and tracking company updates, this can mean identifying worthwhile investments before the larger market catches on. Think of it like sifting through a thrift store. Sure, it takes more time and effort, but you're far more likely to find a unique deal that others have overlooked. In the same way, small cap stocks offer a chance to get ahead of the curve by entering positions before heavy institutional buying drives up prices. Historical performance. What does history say about small cap stocks? The data overwhelmingly supports their long-term strength. Research shows that small cap stocks, as a group, tend to outperform large cap stocks over extended periods. For example, the Russell 2000, a popular benchmark for small cap performance, has consistently delivered higher average annual returns than benchmarks like the S&P 500. This pattern holds true during periods of economic expansion, where smaller companies often become agile and thrive more quickly than their larger, slower-moving peers. While they do experience more volatility during downturns, their ability to recover and outperform larger companies over time has made them a favorite among many seasoned investors. It's critical to note that this historical strength doesn't eliminate risk. Small cap investing still comes with challenges. But if you can weather the ups and downs, small cap stocks offer an attractive path for building long-term wealth. Investing in small cap stocks may feel like taking the scenic route compared to sticking with large cap behemoths. However, that extra time and effort can make all the difference in shaping your portfolio's future returns. Risks associated with small cap stock investing. Investing in small cap stocks comes with its fair share of challenges. While they offer high growth potential, the risks involved can't be overlooked. Understanding these risks is critical for any investor who wants to navigate this exciting but uncertain part of the market effectively. Volatility and price fluctuations. Small cap stocks are notoriously volatile. This means their prices can swing wildly, sometimes within hours or days. Why does this happen? It's often due to their smaller size and lower market caps, which make them more sensitive to market events and investor sentiment. For example, good news, like a product launch, can send a small company's stock soaring, but bad news, like a missed earnings report, can just as easily trigger steep declines. In a way, it's like riding a roller coaster where the highs feel exhilarating, but the drops can be stomach-turning. This level of unpredictability makes small cap stocks riskier than mid or large cap stocks, which tend to be more stable. For long-term investors, frequent price swings might not matter much. But if you're someone who stresses over daily portfolio fluctuations, this could be a tough ride. So how should you approach this as an investor? Focus on the long-term potential of small caps rather than their day-to-day movements. A steady hand can go a long way in dealing with the inevitable turbulence. Liquidity concerns. One of the lesser-known challenges of small-cap investing is limited liquidity. Liquidity refers to how easily you can buy or sell a stock without affecting its price. Large-cap stocks, traded in massive volumes every day, are highly liquid. Small caps? Not so much. Because fewer shares are traded daily, it can be harder to find a buyer or seller when you're ready to make a move. Imagine trying to sell rare collectibles at a yard sale. You might have to wait until the right buyer comes along. Similarly, selling small cap stocks during market turmoil or when demand dries up can result in significant price discounts. Low liquidity also increases something called the bid-ask spread, which is the difference between the price buyers are willing to pay, bid, and the price sellers are asking for. Wider spreads add hidden costs to your trade and can eat into your returns over time. For investors with larger portfolios, liquidity constraints can pose an even bigger problem. Large trades in illiquid stocks may cause price distortions, forcing you to sell at lower prices than expected. If you're investing in small caps, keeping these liquidity issues in mind is crucial. Economic sensitivities. Small cap companies are often more vulnerable to changes in the overall economy. Larger companies generally have the resources to weather economic downturns, but small caps? They don't always have that safety net. Here's why. Limited resources. Small businesses typically operate on tighter budgets. In tough times, they may struggle to secure financing or maintain cash flow to cover expenses. Even a slight downturn in sales could push some of them into financial trouble. Higher debt levels. Many small-cap companies depend on borrowing to fund growth. When interest rates rise, servicing that debt becomes more expensive, cutting into profits and potentially stalling expansion plans. Industry risk. Small-cap stocks often dominate industries that are highly dependent on consumer spending, such as retail, tourism, or discretionary products. During a recession, consumers tighten their wallets, leaving these businesses more exposed to revenue declines. Think of these companies like small boats out on the open sea, while large-cap companies are like massive cruise ships that can handle rough waters. Small caps are more likely to get tossed around by the waves. When the economy slows, small cap stocks often feel the pressure first and take longer to recover when the storm clears. For investors, this means paying close attention to economic cycles and broader market trends. While small cap stocks can deliver incredible growth in good times, they can also be hardest hit during recessions. If you want to succeed in this market, it's essential to prepare for both. Being aware of these risks doesn't mean you need to steer clear of small cap stocks altogether. Instead, understanding them empowers you to make smarter decisions, whether it's diversifying your investments, setting realistic expectations, or maintaining discipline during volatile periods. Strategies for investing in small cap stocks. Investing in small cap stocks can be a rewarding way to grow your portfolio. but it requires a thoughtful approach. These stocks are known for their potential to deliver high returns, yet they also come with elevated risks. Below are practical strategies to help you navigate this nuanced area of investing effectively. Diversification to mitigate risk. When dealing with small-cap stocks, one of the most important rules is to spread your risk. These companies are often more volatile and less stable than their larger counterparts, making diversification essential. Imagine you're at a buffet. If you only fill your plate with one type of dish and it's not to your liking, the entire meal is ruined. But if you sample multiple options, you have a better chance of enjoying your overall experience. Similarly, investing in a mix of small-cap stocks across different sectors helps ensure that if one sector falters, the others might offset losses. One simple way to achieve diversification is through ETFs, like IWM, which give you access to a broad range of small-cap companies with just a single purchase. This lowers the chances of putting all your eggs in one basket. Focus on long-term growth. The key to successful small-cap investing is patience. Small-cap stocks tend to be more volatile, meaning their prices may fluctuate widely in the short term. However, these companies can experience significant growth over the long term as they scale and capture more market share. For investors with a long-term horizon, it's crucial to focus on the bigger picture. Keep your eyes on the fundamental strength of the company rather than its short-term fluctuations. Over time, companies with strong business models, solid leadership, and growth potential will reward investors who stick with them through thick and thin. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.